Hey guys, so how you doing? So I'm Dan from Trading with Dan, and this is the risk management section of our mentoring program. Right, so first and foremost, the main aim trading, especially when you're starting, is to not lose money. So that's the main thing you need to try and do, is not lose money. Most traders, most new traders especially, they will lose all their money. Basically, I think something like 90% of all new traders lose 90% of their money in like the first 90 days. I think that's the statistic that goes around. So if you can just not lose money, that immediately puts you in the top 10% of traders, doesn't it? 10% of new traders at least. So that has to be your first aim. I mean, obviously making money is great in trading. That's what we're here for. That's what we want to do. But when you are starting, you need to first just start with the basics. Start with the not losing money. Like, let's overcome that hurdle first. Right, so we're going to look at some of the reasons how people lose money in trading, some of the common mistakes, and by far the most common mistake, the main thing that will cause people to blow up and lose all their accounts, is adding to losing trades. And this is also known as averaging offside. That's what I call it, averaging offside. But yeah, so adding to losing trades. So for example, you put on a trade, your stop loss is like say 1%, and you're risking X amount of your account on that trade. You get to the 1%, you think, oh, I don't want to take my stop now, I'm going to move it to 2%, and then I'm going to increase the position size, so it's double the size now. So I'm basically just put the same position on again, extra at this price level. So obviously now you've got twice a position, twice the size, twice as much risk as you wanted to take, and then you're also sat on the loss, obviously, from your original position, your original entry. So then what can happen if the market moves against you? You're now losing double the amount of money per dollar movement, because you've got double the position size. And then maybe you add to it one last time thinking, oh, this is it, and then maybe you add double the amount this time, so you've got 4 times your original position size on offside, and the market moving against you. And then remember, the trend is your friend. Trend is your friend in trading. So if the market is moving that way, I mean, you could expect it to keep moving that way, and now you're sat with four times your position size, and the market moving against you, and it's not going to be long before you will lose a lot of your account. So adding to losing trades is very dangerous. It's not a great thing to do. You can actually do this, add to losing trades, if it is part of your predefined trading plan. So obviously that ties us into the last point. So if it is actually your plan to ladder into a position, because I'll do this, lots of traders do this, you ladder in a position, you ladder out of the position. That's what I do a lot with trading, but that is my plan. I still have my stop at a certain amount. So I have my initial entry, I have then my laddered entries, and then I have my stop under all of those entries. So, and that is my plan, and obviously I stick to it. So yeah, so you can do that, but I just mean, if you put on your initial position and then with no plan to add more, but then you add more, doubling your risk, tripling your risk, quadrupling your risk, and that it is a way that you are eventually going to lose money. I mean, sometimes your position will come back and you'll get to a break even, or even a little bit of profit, or even a lot of profit, because now you've got a bigger position size that's moving in your favor, if that does happen. But like, it only takes one time for it just to keep moving against you to blow up your whole account, and then that's it, you can't trade anymore. So the next one is being over leveraged. So let's say you have a 1 Bitcoin account and you put on leverage that whole Bitcoin, 1 Bitcoin 100x. So now you're exposed to the actual price gains and losses of 100 Bitcoin. So what can happen is, obviously, if Bitcoin goes up 1%, then you're going to get 1% times 100 is 100%, so you're actually going to double your money. So you'll have 2 Bitcoin, just if it only moves up 1%. So, but what if it moves down? If it moves down 1%, then you're literally going to lose your whole Bitcoin, which is 100% of your account. So being over leveraged, obviously 100x is an extreme example, but like 100x, even 50x, 25x, you could be over leveraging your account, and you could start losing money pretty quick, and then it takes a lot more money, a lot more percentage gains to then make that money back. Or you have to over leverage yourself even more to then try and make that money back with a smaller position size. So what you'll probably find out, especially as a new and experienced trader, is that you'll just end up losing money, lose all your account, chasing those losses, and then you're just out and you can't trade anymore. So yeah, that brings us to our last point, not having a predefined trading plan. So not just with your entry, I mean, you can ladder entries in, and that's obviously a predefined trading plan, but just generally speaking, if you don't have like like a way to enter trades that you obviously know gives you an edge, where your stops should be, what that means your position size should be, where your take profits should be. I mean, if you don't have all these things in place before you start trading, start placing trades, then it is likely you will lose money, because you're just fumbling around in the dark, aren't you? You don't necessarily really have a plan. So if you don't have a plan, how can you really hope to succeed unless it's just blind luck? And obviously blind luck is not really a long-term plan for trading. Right, so let's bring us to how much to risk per trade. So how much risk are we taking on? So the risk you take on in trading, there's basically three factors that they all interrelate. They're like a triangle of three factors, a trifecta of factors that basically just govern how much risk it is you're actually taking per trade. So the first one is your account size. Obviously, if you've got a big account size and you take big positions, then that's not as risky as taking the same size big positions with a smaller account size. And then similarly, if you take, it's basically the same thing. This is how they relate to each other. If you take a big position size with a big account, it's not as risky as taking a big position size with a smaller account. It's just the converse of what we said. This is what I mean how these interrelate. So finally, the third one is the distance, the stop losses from your entry. So regardless of your account size or your position size, if you put on a position based on whatever your account size is, and then you have a stop at 1%, then you're predefining that amount you can lose. But then say you've got a stop at 5%, so you can actually lose 5 times the amount. So your risk is 5 times the amount. So where your stop is from your entry is obviously very important when to calculate how much risk you are taking per trade. Right, so you're going to have losses when you trade, and pretty much every trader will have those days or that trade where they have a big loss. So how you handle that loss, how you react to that, is obviously key going forwards. And new inexperienced traders will usually react in a certain way, and more experienced traders will then usually react in a different way. So what an experienced trader will typically try and do is to try and chase the loss. So what they'll do is they'll trade bigger position sizes to try and make that money back as quick as they can. And I mean, you just got to think about it. You've taken a loss, your account size has gone down a bit, or a lot if it was a big loss, and now you're trading position sizes that were bigger than you were trading before, trying to chase this loss. So you've got a double bubble increasing your risk. You've got a smaller account size and a bigger position size. So that is just a recipe for disaster. I mean, it may pay off, I mean it may not pay off, and if it doesn't pay off, then that's it, that's all your capital gone, you can't trade anymore. And if it does pay off, you're just back at square one, but you've taken a massive risk to get nowhere. So I mean, it's not ideal either way. But yeah, so inexperienced traders will often try and chase a loss. They'll revenge trade. They won't trade properly. They'll trade emotionally. They'll maybe overtrade. There's lots of things that they'll do to try and get that loss back. So what's different with an experienced trader? So an experienced trader will just use it as an opportunity to learn. So they can see what happened. Did they make a mistake? Is it something they can change? Was it not a mistake that they made? Is it just something, an inherent risk in the strategy they have that they need to change? But yeah, they'll assess those and they'll then decide what they need to do with that information. They won't be basically blindly just taking massive extra risk and chasing the losses. So let's say, for example, instead of one big loss, you have a string of losses. So a string of small losses that obviously add up to a big loss. Maybe you get some little wins in between there, but predominantly you're losing overall. So the main thing to do is to take an immediate break from your trading so you can reevaluate your strategy to see what's potentially going wrong here, what you can change, and then what you need to do. So the first thing you'll probably do is look at where your stop losses are placed, because maybe you've got them too tight. Maybe you position your entries are good, you get the overall direction, but like you've got like a 0.1% loss, which is quite easy to get hit. So but you're doing that because you want to trade a big position size, but you don't want to take on a massive risk. You have a really tight stop, but all that happens is you just keep on losing the trades because the top stop's too tight and you keep hitting it. So what you may want to do is trade a smaller position size, but widen out your stops. You're giving your trade a chance to get into profit. You're giving it room to breathe, room to maneuver, room for the random motion of the market. What's known as Brownian motion in calculus, just that random movement. So you're not going to get basically stopped out of your trade based on that. Right, so the next one is you actually need to look at your strategy, what information you're using to enter trades. You need to think whether this is a good strategy, whether what it is right, because it may just be that you don't have a good strategy, and that's that's why you're getting these losses. So another thing that people don't consider, did you take your profit too late or too soon? So say some of those little profits that you made in between the string of little losses, maybe one of those or two of those profits could have been really big profits, and then overall you'd been winning. So it's not actually anything wrong with your strategy, nothing wrong with your string of losses. You can lose, a lot of good traders will lose say 70% of their trades, but their winners are big winners. So did you take profit too early on some of those trades? So if you basically ran and that one trade made the massive profit, it wouldn't matter about all the small losses, you'd still be up overall and your strategy would be working perfectly. So I mean, that is something you can think at. And then also, are you taking profits too late? So does your profit run into a big massive profit, and then you still keep running it and you don't take it off, and then it comes back to maybe a small profit, a break even, or maybe even a loss, and then you take it off. Well, obviously you can't be taking profit on a loss, but yeah, maybe it gets like a small profit again. So you took your profit too late. You didn't take it when you should, and when you had a big profit that would then make your strategy profitable, even though you're getting more losses than winners. So also then finally, you need to actually look and analyze your strategy to see if it's something wrong with what you're doing or whether it was just bad luck, because trading is based on statistics and probabilities, and while something's unlikely to happen, it doesn't mean it can't happen, and it might be unlikely to happen then lots of times in a row, but that could just happen. So that just happens in trading. That happens in everything. Like low probability events, they still happen, they're just less likely to happen, and then they can happen repeatedly, but they're just even less likely to do that as well. So that's sort of thing you need to look at. You need to decide whether this was something actually wrong with my strategy, or whether it was just bad luck that the low probability of something just happened a couple of times, maybe 3 times in a row, and there's nothing you can do about that. Right, so how do we actually calculate risk? So it's a pretty simple formula. It's basically the position size that you want to be taking, so the risk, and then how you calculate what that would be the balance of your account times by how much of that account you want to risk as a percentage. So how much percentage of that balance you want to risk per trade, and then you divide that by the percentage distance to the stop loss from the entry. So this means your position size is calculated by dividing the percentage of your balance you wish to risk by the percentage distance to your stop loss. So, right, we'll have an example just so we can try and clear that up a bit. Right, so don't ask me why we've got this here. I don't know why, but right, but we can see this. It's not very clear, but I can explain this to you. So 1, this level here is our entry. 2, this is where our stop loss is going to be. And 3, this is sort of the ladder tool, like the range tool on TradingView, and this is how you calculate the percentage distance between those two, between 1 and 2. So that will be the percentage that you're risking per movement, basically. So say your balance. So we're going to make this complicated. You don't have a 1 BTC balance. You have a 0.3456 BTC balance in your account, and the BTC price is $5,196. So if you wanted to risk 1% of your account per trade, you first need to work out how many dollars you have. So 5,196 times by 0.345, should be 6 and 3456, and then that will give you 1% of actually your account in dollars would be this gives you your account size in dollars, which is 1,795. So then 1% of your account size in dollars would be $17.95. So this is how much you want to lose on the trade. Not want to lose, but this is how much you are risking losing on a trade based on risking 1% of your account size. So you need to then divide that $17.95 by the distance to your stop loss. So it's not stop loss. So that's 0.67 that we just messaged here. So what we'll do is 17.95 times 0.67%, so that would actually be times 0.0067, because 0.67% as an actual decimal number is 0.0067. So if you divide $17.95 by 0.0067, you get $2,679. So that would be the contract size that you'll trade on Bitmex. One contract is $1, so $2,679 is the position size you will trade. Right, so yeah, so in summary, as we said, one contract on Bitmex is $1. So then with a position size of 2,679 contracts, or $2,679, it will mean if you hit your stop loss, which you placed at 0.67% away from your entry, then you will lose $17.95, and that $17.95 represents a 1% basically loss on your account, and that means the risk to your position is 1% of your balance. So that's the end of this video. That's the end of this section on risk, and I look forward to speaking to you guys on the next.